Welcome to our Hurst Cycles webinar for the 16th of August 2017. My name is David Hickson, and as always, before we take a look at the markets, I must please ask you to read and make sure that you have understood these disclaimers. While you're committing those to memory, I have a little bit of news. Over the past few months, we've been working very hard behind the scenes, putting together a new Hurst Cycles Academy. I'm very excited about it, and we're going to be releasing it upon our current users later this week. So if you are a Sentient Trader user or a Hurst Cycles for MT4 indicator user or a Hurst Signals subscriber, then look out for the email that you're going to be getting later this week inviting you to come along to our new academy. At the moment, we have all of our current courses uploaded to the new platform, which is a really nice new platform. And I'm also in the process of building some new courses. So that's really very exciting. Let's get on to the subject for today, and let's switch to Sentient Trader on this system. There we go. The subject of today's webinar was inspired by an email that I received after our previous webinar. A very interesting email showing me a slightly different analysis of various stock markets, and a really very compelling analyses, very, very interesting analyses that resolve a lot of the dilemmas that we generally have been discussing in analyses of the stock markets recently. So it was a really interesting analysis to look at, and I decided that we had to spend a little more time discussing the stock markets, which is why we're looking at the S&P 500 again today, because I would like to share the analysis with you. The interesting thing about the analysis is that it includes a 6-year cycle. Now, for those of you who are new to Hurst Cycles, you might be scratching your head and saying, but hang on, there isn't a 6-year cycle, because in fact we know that there is a 54-month cycle, there's a 9-year cycle, and an 18-year cycle. Where does the 6-year cycle fit into the picture? And that is because the 6-year cycle is a very interesting cycle that's been discussed for a while. I was originally introduced to it by a Sentient Trader user from Sweden who emailed me and said, I think there's a 6-year cycle. Can you enable Sentient Trader? This is in the very early days of Sentient Trader. Can you enable Sentient Trader to actually perform an analysis that includes a 6-year cycle? Of course, that was a very long time ago, and Sentient Trader can definitely do that now. I've written several blog posts about the concept of a 6-year cycle, and we've even done some webinars about it. But it's not a cycle that I very often sort of bring up, and that's because it interestingly breaks one of the fundamental rules. It breaks the principle of harmonicity. Now, Hurst, of course, originally defined 8 principles that define his cyclic theory, and the concept of a 6-year cycle breaks the principle of harmonicity. So we're going to be discussing that in today's webinar. Just a reminder, in case you didn't read the email that I sent you about today's webinar, that I'm changing the format slightly for today's webinar. And the first half of the webinar, I'm going to be speaking about some sort of big ideas, some theory, longer term picture. And the second half of the webinar, I'm going to get a lot more practical. So if you were one of the people that emailed suggesting that I include some more sort of immediate practical considerations about what's happening in the markets at the moment, then thank you very much. And that's what we're going to be doing in today's webinar. So just to get up to speed before we actually start looking at the 6-year cycle, let me just remind you of some of the salient points that I discussed in the previous webinar. Of course, it is available on YouTube, and so you can easily go and watch it, so I'm not going to repeat everything. But the analysis that you see here is the analysis that we discussed in the previous webinar. The important points are that this big trough here in early 2016, I believe, was a trough of a very prominent cycle. I discussed in the previous webinar that a shorter cycle is working fairly well on this analysis at the moment. So instead of that being a 9-year cycle, it's about a 7 or 7.5 year cycle. And the other sort of really important thing that I discussed in our previous webinar is this peak over here. Because as the markets go up and up and up, we're asking ourselves, where is the peak? And I discussed in the previous webinar that 9-year peak, and again, it's a shorter cycle, so it's about a 7.5 year peak, in my opinion, very probably formed in 2015. Because of the way in which cycles combine, it is absolutely possible that we witnessed a very big cycle peak in 2015. Then, of course, price came down from that peak into the trough in 2016, and since then it has been bouncing up. This analysis explains the current bullishness of the market, and I explained in the previous webinar why I am currently bullish the markets, and explained why because of this analysis. So that was what we discussed in our previous webinar. Let me just quickly show you the composite model line, which we also took a quick look at. The composite model line gives you an idea of what happens if you, I think I need to click that again. There we go. It gives you an idea of what happens if you take all of the analysis information and recombine it using the information about the wavelengths and amplitudes of all the cycles, and then you recombine all of that information, and you end up with a line like that, which in the past shows you what the cycle analysis is telling you would have happened in the markets, or I shouldn't say would have happened, but what did happen according to the cycle analysis. And the line extends into the future, showing that if this analysis continues to be correct and true, then that is what the cycle analysis is telling you to expect. So, of course, the important point to make here is that the composite model line was telling us to expect a continued bullish move up into a peak over here, which is in about early 2019. So it was indicating that the markets could well continue to be bullish for about another year. That's what the cycles are telling us to expect according to this analysis. I know I keep saying that, but it's very, very important that everything's based upon the analysis. So if you change the analysis, then of course your composite model line changes entirely, and your expectations change entirely as well. So let's now take a look at the concept of adding in a 6-year cycle. So let's quickly change charts, and let's speak about the concept of 6-year cycle. First of all, here is a chart without any analysis, because I thought it would be quite useful to discuss, first of all, some of the sort of ideas around a 6-year cycle. And the first thing that it's important to understand is that the addition of a 6-year cycle into an analysis generally means that you're breaking the principle of harmonicity. So what is the principle of harmonicity? Let me see if I can write it. This computer sort of has a bit of a lag. Harmonicity. So the principle of harmonicity, as originally defined by Hurst, tells us that the relationship between the wavelengths of the cycles that influence financial markets, the relationship between the wavelengths is a ratio that I call the harmonic ratio, and it is a ratio which is a small integer value. What does that mean? Well, it means that the ratio is either 2:1 or 3:1, which means that if you pick a cycle, then the wavelength of that cycle will generally be 2 times or 3 times longer than the cycle shorter than it. Or if you pick a cycle, then the wavelength of that cycle will be generally a half or a third of the wavelength of the cycle longer than it. So you end up with harmonic ratios, which are presented as two numbers, of course, as all ratios are, and 1 to 2, 1 to 3, or you could write them the other way around, depending which way you're doing it. So you could say 2 to 1 and 3 to 1. Okay, that's what the principle of harmonicity tells us. And so the relationship between the wavelengths of all cycles in our nominal model, which is the list of cycles that we use to analyze the market, is either 2 to 1 or 3 to 1. Okay, I tend to have a bit of a questioning mind. One of the first things I did when I started working on Sentient Trader was I asked myself, are these principles really all still viable? Because Hurst originally came up with these ideas 50 years ago. Are the markets still working in this way, or aren't they? And indeed, I believe the principle of harmonicity is still viable, but I, for many years, have been of the opinion that the principle of harmonicity needs to be modified slightly, or should I say that we bend the rule slightly. So we're not breaking the rule, but we are bending it slightly. And I believe that there is good evidence, particularly when you're working on the intraday level, but also on the end of day level. There's good evidence that you can get what I call complex harmonic ratios, such as 4 to 3 or 3 to 2. So what that means is that the relationship between the wavelengths of adjacent cycles in your nominal model have a ratio of 4 to 3 or 3 to 2. Okay, so it's not breaking the rule of harmonicity, because there is still a defined harmonic ratio between the cycles. But it's what I call a complex harmonic ratio, because it is not a simple integer value. And the simple integer value was a part of Hurst's original definition of the principle of harmonicity. Okay, I see many people joining us and saying hello to everybody. I hope that I hope you're able to catch up if you've joined us a little bit late. But welcome to the webinar. So for many years now, Sentient Trader has had the ability to perform an analysis using a variation of the principle of harmonicity, which is the ability to apply complex harmonic ratios to the cycles that it works with. So let's take a look at what that actually means. And let's ask, why is it important? Why do we want to be bending the rules? Well, one of the big reasons why we would want to be bending the rules is because of some interesting things that have happened in the market, particularly over the last few years, where you get a trough, a fairly prominent trough, then another prominent trough, and then another prominent trough. And particularly when you're looking at that combination of troughs over there, you're getting a sort of a double tap there of those low levels, and our normal nominal model always ends up providing us with a bit of an anomaly there. We ask ourselves, why do we get two such prominent troughs? And then for a period of several years, we get no prominent troughs at all. And then over here we get a prominent trough, and then we get another prominent trough. So you see, we're in terms of the troughs, we're getting that sort of double tap thing repeating. Let me just clear that and draw it again. So we're getting a sort of a double low there. We're getting a double low there. Okay, and we're also getting sort of something similar over there, but there are a few anomalies, and you might have seen a webinar that I did last year with Sid Norris of Elliott Wave Plus, in which he presented a very interesting argument suggesting that the trough that we saw here in 2007 was in fact a trough of the 54-month cycle. Interestingly, a famous Hurst Cycles analyst who was writing in those days, very sadly has passed away, Airedale, or Bob Chomsky, wrote way back in 2007 that he believed that was a trough of the 54-month cycle. Let me just write a letter M there. And we discussed in the webinar I mentioned a moment ago that the important sort of 9-year trough could have occurred here or could have occurred here. I'll let you go back and review that webinar. It's a very interesting concept, and it's something that Hurst Cycles analysts have been debating for years. Since those troughs formed in the market, there's been a debate about which trough is it. Is that the 54-month cycle trough, or should the 9-year trough be in 2009, or should it be in 2012? That's the big question. I've been scribbling on this chart. So we have a big question. We've got a trough here or a trough here. Which is the really important one? And if we measure the number of bars from here to here, we get roughly 6 years. I'll let you go and measure that for yourself, but it is roughly 6 years from there to there, and then of course we had another trough that was later over here, which was about 3 years later. Okay, so that's why there's been a debate. I won't dwell on it. I expect that you are fairly familiar with that debate. So why is a 6-year cycle important and interesting? Well, let me show you the analysis on this chart using a nominal model that includes a 6-year cycle. And there it is. The first thing that will strike you, I expect, is that we have these rather strange floating diamonds. Can you see that floating diamond there? That floating diamond and that floating diamond. Okay. Now the reason we have floating diamonds, you're used to seeing these very neat stacks of diamonds, okay, because of the principle of harmonicity, which tells us that when a longer cycle forms a trough, all of the shorter cycles must also have formed a trough at the same time. So because we're bending the rule of the principle of harmonicity, we get these floating diamonds over here. So this diamond over here in March of 2009 is in fact a 6-year diamond. 6-year. And over here in late 2011, that's a 9-year diamond. And over here again is a 6-year. And this diamond over here is a 54-month. So the interesting thing about this analysis, and the reason why I thought it was really important to discuss it, is that including this 6-year cycle into our nominal model provides a rationale, if you like, for some of the anomalies that we've been facing. In particular, it provides us for a way of explaining this big trough over here in 2009 and the fact that we have another trough that over there is at exactly 9 years, which is a cycle that we are familiar and we're used to working with. It also provides a way of understanding what was happening over here in 2015. Well, I think that's late 2014, that trough there, and then this trough here was early 2016. It provides a way of understanding why we had two troughs like that. And the reason is because that was a 6-year trough in 2014, and this was a 54-month cycle trough, which is only 2 cycles down. I beg your pardon, it's only 1 cycle down from the 6-year cycle. And so that provides us with a reason for those, for those double troughs over there, and it provides us with an understanding of why we have this anomaly over here between 2009 and 2012. Let's add a peak analysis to this, and I will show you how the peak analysis looks. Interestingly, the peak analysis, let me just turn it on. There we go. And let me zoom all the way out. I'm not sure why this chart isn't zoomed all the way out. There we go. Okay. All right. So now that we can see the peak analysis, you can see that the peak analysis is doing the same thing in that it is providing us with some floating triangles, because of course we use triangles to demarcate the positions of the peaks in Sentient Trader. And so this peak over here was a peak of the 9-year cycle. You should know I'm using a slightly shorter cycle length for the peaks. Traditionally, of course, we expect troughs to be synchronized in stock markets, and we don't really expect peaks to be synchronized, which means that generally your trough analysis is going to be very good, and your peak analysis will probably not be so good when it comes to a stock market. Different markets, of course, you will find the peak analysis will be better than the trough analysis. Generally, one analysis is better than the other. But here we can see that's a 9-year cycle peak over there in 2007, I think it was. Here's a 6-year cycle peak, and I think you can see if we look at that peak in price why I'm saying this is not quite such a good analysis, because the peak analysis is not as good as the trough analysis, because the important peaks are not quite as clearly defined in price as the troughs are. But the interesting thing about applying this peak analysis on here is that we also get an explanation for these double peaks over here. Here we had a peak in, you might say it's not really a double top, but it is certainly a double peak, and that's because we had a 6-year peak over there, so that's 6-year, and here we had a 54-month peak over here. That was in, when was that, 2010, 2011, I think. Okay, so that's the peak analysis. I think it's a very interesting idea, the idea of including a 6-year cycle. Let me just quickly spend a moment explaining how it's done, or at least what the nominal model looks like. We have a 9-year cycle, and then we have a 6-year cycle, and then we have a 54-month cycle. So I'm using here the default standard Hurst nominal model, except for one thing, which is that I am inserting the 6-year cycle over there. And the way in which the harmonic ratios work is that you have a 3:2 harmonic ratio. I think it's up here, the 3:2, 3, because you get 3 6-year cycles for every 2 9-year cycles, and you also have a 4:3 normal harmonic ratio between the 6-year and the 54-month cycle, because you have 4 54-month cycles for every 3 6-year cycles. Okay, so it's a really interesting concept. I hope you are finding this analysis interesting. But let's move on to the second part of today's webinar. Oops, that's switched to the wrong slide, where I wanted to speak about some of the practical aspects of working with Hurst Cycles. And I'm going to tie it into the conversation that we've just been having about working with a 6-year cycle, because in fact you will see that when working with the 6-year cycle, you're able to work with 2 different analyses and come to pretty much the same decision about what you should be doing in terms of trading. Okay, so this is the overview chart that we have on Hurst Signals at the moment. Now the overview chart shows us the bigger picture of the analysis that is being used to generate some trading opportunities which are identified by the Hurst Signals system. So now the analysis on the Hurst Signals system differs slightly from the analysis that I've been discussing in today's webinar and also in our previous webinar. And I'm often asked, why is it? Why does the Hurst Signals system have a slightly different analysis? And the reason for that is because in these webinars I'm presenting often slightly different ideas, new ideas, untested ideas. I'm presenting analyses that I think are interesting, but they are not necessarily everybody's opinion. And if you're going to make trading decisions, you want to be making trading decisions on a sort of tried and tested analysis, rather than an analysis that looks interesting but that might not turn out to be entirely correct, of course. So the overview on the Hurst Signals chart, you can see, presents us with a 54-month cycle over here at the beginning of 2016, and it presents us with this 18-month cycle over here in I think that was that late August. So in other words, this trough over here is an 18-month cycle trough. Okay, so that's what we're seeing on the overview. Now let me come back to our analysis on that we've just been looking at. Although these are different analyses, and let me just zoom in on this chart. Although these are different analyses, we have two very important things that are entirely identical, entirely the same, which is that we have a 54-month cycle trough over here in 2016, and we have an 18-month cycle trough here in August of this year, 2017. So although we're looking at two very different analyses, and this analysis we're looking at now includes a 6-year cycle, whereas the Hurst Signals analysis doesn't include a 6-year cycle. Although we've got two very different analyses, the sort of important parts of the analysis in terms of the major troughs are, to all intents and purposes, absolutely identical. And that's a very important point. I call it the robustness of working with Hurst cycles. Even though different analysts will have fairly different analyses, very often you're going to end up making the same trading decisions. So let's start thinking about some trading decisions. Looking at this chart, and let me try and turn this pen on if this computer will allow me to. Looking at this chart, what do you think we are expecting right now in terms of trading? Are we going to be trading long, or are we going to be trading short? Well, the first thing that's really obvious from this chart is that the market at the moment is a bullish market. It doesn't take a genius to recognize that, okay? It's fairly obvious. The market is bullish at the moment. Okay, you need to be very careful of stepping in front of a moving train. This train is moving, and it's moving upwards. Okay, so although of course we are expecting corrections and we're expecting the market to come down again, the first thing to keep in mind whenever you're considering a trading opportunity is what is the bigger picture telling us. And the bigger picture here is telling us that we're in a bull market. So if we're going to enter into a short trade, we need to be very careful about our consideration of that trade. So let's take a look at the next chart that we use on Hurst Signals, which is our 3-month chart. There is the 3-month chart, which now is giving us a little bit more detail. And here we can see the 18-month cycle trough that we saw in the previous chart, and we can see the bar count, the number of days since that trough formed, which this is of course Friday night's analysis. As of Friday night, it was 53 days. Okay, what else can we see in terms of the analysis at the foot of the chart? Well, the first thing that you must realize is that, of course, using Hurst Signals, we are trading interaction with this purple line, the 20-day FLD, and we are entering trades that play out over an 80-day cycle. So the 80-day cycle has, of course, been going up since the 18-month cycle trough in August, and the 80-day cycle is expected to form a trough, the next cycle trough where this nest of lows is. Now that's a very beautiful nest of lows, by which I mean, can you see how neatly lined up those circles are? When you see neatly lined up circles, can I move up the, yes, marker, I'll try and do that. Okay, there we go. Hopefully you can now see the time scale. Okay, it's kind of small, I don't know if you can read it, but there it is. Okay, so we have a very neat nest of lows at the foot of that chart, and very accurately lined up circles. That is very often an indication of a good analysis. Not always. Sometimes you'll see very neat nests of lows and the analysis isn't actually very good. It's just pure chance. But very often it is an indication of a good analysis. And so this chart is telling us that we are expecting an 80-day trough to occur. And let me just move those things so we can see the date. Basically at the end of October or the very beginning of November. Okay, so that's when we're expecting the 80-day cycle trough to occur. So working with the FLD trading strategy is a matter of identifying the interactions between price and that purple line, the 20-day FLD. And the sequence of interactions follows a very reliable sequence. The interactions follow a very reliable sequence. The first one that we get is this interaction A here, where price crosses up above the FLD. It reaches its target, often exceeds it a little bit, and then it drops down in what's called a B category interaction, and it touches or finds support at the 20-day FLD. Let me see if I can switch to the 6-week chart so we can look at this in a little bit more detail. I think the 6-week chart will be showing us that. There we go. All right, so you're seeing the dates there. Okay, so the second interaction between price and the FLD is a matter of price coming down and finding support at the FLD. Okay, which it did very accurately there in the second week of September. That was the 5th of September. You can see how accurately price came down, found support at the level of that FLD, which should occur synchronously at the same time as the 20-day cycle trough, which is exactly what happened. Interaction C is when price breaks up away from the FLD. And you can see it spent the rest of that week sort of trying to think about what it was trying to do. It was trapped in something I call the bubble between the 20-day and the 10-day FLDs, but let's not dwell on that. And the next week it bounced up in the C category interaction. Now, the next interaction is the D category interaction over here, where price comes down, is expected to cross below the 20-day FLD until it forms the 40-day cycle trough. So there is the 40-day cycle trough. Now, this is where things get interesting when you're considering your trading opportunities, because normally a D category interaction will cross down below the FLD and extend the same distance downwards. That would have brought the move down to the 40-day cycle trough down to this level over here, 2480 roughly. I mean, I'm just very, very roughly sort of drawing these levels on the chart. But you can see what happened. Price came down, crossed below the FLD, yes, moved a bit down below it, but it did not achieve its target. Now that is an important event that you need to look at, and you need to understand what is happening when it came down and didn't actually hit that target. Is it because the FLD strategy doesn't work? Is it giving us targets that don't manifest? No, it's telling us, it's giving us a very important message. If price is not achieving its short targets, then it tells us that the market is particularly bullish. Okay? In other words, what we call the underlying trend, which is mentioned over here in the text detail, and we're going to take a look at that text detail in a moment. The underlying trend is bullish, so the market is bullish. And that's no surprise. We started off looking at the overview chart, and I said, well, the first thing to notice about this is that we are in a bull market. So when price came down below the 20-day FLD over here, we expected it to achieve this dashed line because that would have been the cycle target. That's the target that would have been generated by price crossing down below the FLD line. Price didn't achieve that target, as you can see. It didn't get down there. It wasn't far off, but it didn't make it down there, and it bounced straight back up again. That's not an indication that this FLD business doesn't work, although I know some people interpret it that way, which is a mistake in my opinion. It is in fact because the market is so bullish. And the first thing I said when considering this is that we need to be careful about short trades because they will often not achieve their targets when you're in a very bullish market. And of course that's because of what we call the underlying trend, which you can see at the moment is +3. I'm not sure what the underlying trend was back in the middle of September, but it was, if anything, it was even greater because there were more cycles moving upwards. Okay, so let me just clear this. So following price coming down to the FLD, it should form the 40-day cycle trough, which it did on the 25th of September, according to this analysis. Then it crosses back up above the FLD in what's called an E category interaction. In this particular example, it didn't really need to cross above the FLD because it hardly got below it. Okay, but it will bounce up above it. And it came up to new highs, of course. Now, as a matter of interest, when we did our previous webinar was on this day over here, and I presented the concept that this is a bullish market and is going to continue being a bullish market. Just a really little small tiny rule of thumb: if you analyze a market, and this works well intraday, if you analyze a market and you say, okay, we're in a bull market, but then price comes down to an FLD, just generally, what do you expect price to do? You don't expect price to cross cleanly below the FLD. Very often the FLD will provide support. FLDs give you great levels of support. So what you could have done is simply watched how price reacted to that FLD. For 1 day, 2 days, 3 days, 4 days, it tracked along that FLD. It was clearly finding support at the level of the FLD, and then on the fifth day it broke up above its previous highs. Okay, so what are we expecting next? Well, the next letter in the sequence, I'm sure I don't need to tell you, is the letter F. So we are expecting a category F trade, or at least I should say a category F interaction, okay, between price and the FLD. A category F interaction is when price crosses down below the FLD on its way down to this 80-day cycle trough. So our next trading opportunity would be a short trade when price crosses down below the 20-day FLD as it comes down to the 80-day cycle trough, which is expected in the last few days of October, first few days of November, perhaps. Now, what did I say right at the beginning? You've got to be really careful about short trades because we're in a bullish market. Okay, so yes, the Hurst Signals system is identifying a trade. It's identified a trading opportunity. But now you need to think about whether you really want to take that trading opportunity. A move down into an 80-day cycle trough is usually a fairly good move. But we are in a bullish market. And there are a couple of possibilities. The one possibility is the price will sort of come along, it'll flatline, it'll dip down below the FLD at such a time that its target is really very sort of minimal, and we'll get just a little move down into that 80-day cycle trough at the end of October. I would say this is not the best opportunity that we've seen all year, and we're probably going to get much better opportunities following it. In particular, the bounce out of the 80-day cycle trough. The next trade is going to be more interesting to me, but of course you might have a different opinion. The idea of the Hurst Signals system is that it identifies trading opportunities and it tells you about them. Whether they're going to be the kind of trading opportunity that you want to take is something that you need to decide. Let's take a look at a bit more detail, which is presented at the top of that chart, and see if there's any interesting information there. Here we go. Let's switch this. All right. So here's. I hope it's not too blurred. I did sort of blow it up, and it's looking a bit blurred on this side, but hopefully you can read it. If you have any questions, please do ask them now. Particularly now we're talking about the practical stuff. There's a lot of detail here that you need to understand. So. The first thing that the information tells us is to bear in mind trading guidelines on a Monday. What does that mean? Well, we trade cycles, okay, and cycles influence financial markets. Over the weekend, Saturday and Sunday, most traders take time off and they don't do any trading, so we have no price records of what happened over the weekend. And yet the cycles that are influencing the financial markets have moved. And we could have a long debate about that, but it's one of the fundamental concepts behind Hurst Cycles, that when we're not trading, the cycles are still influencing the markets. But the traders, when they arrive on the trading floor, don't know that. Although I've discovered many floor traders do work with Hurst Cycles. So in fact, they probably do know it. But what often happens on a Monday morning is that you can get quite a little bit of volatility as the market tries to settle down and find its price. And what traders will often do is they'll run the market to the Friday's extremes just to see if they can pick up some extra orders and catch unwary traders who set stop orders over the weekend, which is a kind of a foolish thing to do in my opinion. And that's what the guidelines are for trading on a Monday. Yes, exactly. As Ball Trader says, events happen over the weekend when markets are closed and price can't react until Monday's opening. Yes, exactly. We can't see any evidence. So there's quite a lot of volatility on a Monday morning, and so that's why you need to be careful. Then you can see that the information tells us what we've just figured out for ourselves, that the next trading opportunity is a category F. Then we see the level of the FLD, the 20-day and the 10-day, because sometimes the 10-day FLD is useful. And here is the trading opportunity, which is to make a short entry at a level of 25.46. And here are the targets. Now, target 2 is the cycle target. So that's at 25.35. So there are only 11, what are those? Those are points. There are only 11 points between the entry and the target. So let's just go back to one of our other charts and see what this trading opportunity is actually telling us right now. And you can decide for yourself whether it would be a trading opportunity that you would be interested in taking. First of all, the entry level is at a level of 25.46. So it's a little difficult to see on this scale, but it's over there. So what's the first thing that occurs to you? Well, that's a kind of a rhetorical question, because I'm probably not going to wait for the answer. But there should be something that immediately jumps out at you about this chart, about that entry level at 25.46. What immediately jumps out at me is that last Monday's low over there was below that level. Last Monday's low, I believe, was about 25.40. Okay, so we've got an entry level that's only 6 points above last Monday's low. I don't really want to sort of jump in there, because if price comes down to last Monday's low on an intraday basis, we could very easily get a double bottom there, last Monday's low and a nice low this week, and price could bounce up. So I'm not going to jump in at the entry level of 25.46, unless of course I'm trading intraday and I'm willing to profit from a 6-point move, which is not an insignificant move, but I'm speaking about sort of trading longer term and looking at catching the really bigger moves. Now, a category F trade, a short trade, should be a good, profitable trade. But when we have a very bullish market and the underlying trend here is +3, when we have a very bullish underlying trend of +3, a short trade is not really a very good trading opportunity. If you were desperate to take this trade, despite the fact that we're in a bullish market and you really want to be trading and you want to catch that move down, then what I would recommend is that you watch price as it comes down to the FLD and you watch its behavior. We do expect price to cross down below that FLD, but as I pointed out earlier, the cycle target, this T2 target over here at 25.35, is not far below that FLD. So, even if it does cross down there, it would fulfill its target at 25.35. That's really not a very impressive trading opportunity. But if you have reason to believe that the market is showing weakness, and last week's price action is what David Weiss, I'm not sure if it's Weiss or Weiss, calls accumulation. He's a wonderful man, David Weiss. I've had some conversations with him about the combination between Hurst Cycles and his work. You should definitely have a look at it. I think the website, I'm just going to write it here, Weiss, W-I-S, on Wyckoff. It works with Wyckoffs. He works with Wyckoffs. So search for Weiss on Wyckoff. Is it one F or two? Let's go for two. I think it's two Fs. Yes, that's right. Weiss wave. The Weiss wave. Basically, we're running out of time, but the Weiss wave works with volume. So it looks at volume behavior, and you get what's called shortening of the thrust. And so as you get the moves up, the motivation of volume, if you like, tends to diminish as you move up, cumulative volume. So what was I saying? Yes, if you have reason to believe that this is the end of the big bullish run, then you might want to catch this short trade coming down. I wouldn't jump in at exactly the level of the FLD. I would wait to see how price behaves at the level of that FLD, because as we saw over here, the FLD is a powerful line. It can provide support. We are expecting price to cross down because it should do to form this 80-day cycle trough, but the markets are surprising places. They always give us what we expect, but they often do it in unexpected ways. And so we are expecting an 80-day cycle trough to form at the end of October, and there might be a trading opportunity for taking that trade, but you would really need to stay on your toes. You would need to watch price very carefully. You would want to be keeping a very tight stop in case when price hit the FLD, it is given a new lease on life and it simply bounces back up again. So that is the trading opportunity at the moment in the S&P 500. The final thing that I'd like to say is what is the real trading opportunity on this chart at the moment, according to everything that we have seen. And let's just go back to Sentient Trader and let's ask ourselves what this analysis that we looked at earlier, the breaking of the harmonic pattern, what is this analysis telling us? Is it giving us any extra information? Interesting information, not interesting information? Well, as you can see here, we have exactly the same situation with an 80-day cycle trough. Let me change the color of this pen. We have an 80-day cycle trough over here at the end of October, last few days of October, and you can probably see a piece of information on this chart that gives us reason to expect that actually the move down might be a little stronger than we would expect purely from looking at the underlying trend, which is bullish, and the fact that the market is so bullish. And that is this nest of highs over here. You see that nest of highs? That is telling us that we are expecting an 80-day cycle trough to form right now. If an 80-day cycle trough forms now, then the move from an 80-day cycle trough down, 80-day cycle peak, I beg your pardon, down into an 80-day cycle trough could be a little bit more impressive than looking at a trough-only analysis would lead us to believe. So there is a possible short trading opportunity here, but I think that the really good trading opportunity probably should be jumping out at you, which is the move from this 80-day cycle trough, wherever it occurs, up to this magnificent nest of highs over here, which is the 18-month nest of highs. That, in my opinion, is the better trading opportunity. If you're a long-term or a swing trader, that's the better trading opportunity, would be to wait for the market to bounce out of the trough at the end of October for a ride up to the 18-month cycle peak that we're expecting in early December. Of course, by the time we get to the end of October, we might have reason to reanalyze, and we might find that that trading opportunity that we're seeing now, a full few weeks ahead, has disappeared into thin air because the analysis changes. You have to update your analysis every day when you're working with Hurst Cycles, or every week if you're a really long-term trader. You have to update your analysis. If the analysis changes, your trading decisions must change to match. I see David at Trading Hurst, useful tip is to put on some of the longer cycle FLDs for a confluence of targets. Exactly. It's a fantastic thing to do, is to work with all the tools at your disposal, all the cycles at your disposal. Today we just scratched the surface of considering the next trading opportunity, but indeed you should look at many different FLDs, the longer cycle FLDs and so forth. A Bull Trader mentioned a volume spike at the top, which is something that David Weiss, I actually don't know how to pronounce his name, is something that he speaks about. Bull Trader says he thought indexes only used troughs for cycles, commodities used peaks. Yes, but as David at Trading Hurst mentions, you can use both in his experience, and one is usually more robust than the other. And another question from Bull Trader: do you use Fourier analysis to find the frequency of cycles and harmonics? Yes, indeed. One of the first things that Sentient Trader does is it performs a Fourier analysis, and let me quickly show you the summary analysis panel. Right, and here we go. Here's the summary analysis panel, and this chart here is the results of the spectral analysis, a type of Fourier transform on the daily, the weekly, and the monthly data. Okay, so there's some quite interesting information there, which Sentient Trader uses in the initial stage of its analysis. It uses it in exactly the same way that Hurst recommended using it in his Hurst Cycles course. So, on that note, I am going to thank you again for joining me in today's webinar. Thank you for your interest in Hurst Cycles. If you're a Sentient Trader user or Hurst Signals subscriber or Hurst Cycles indicator on MT4 user, please look out for our email later this week about our new academy, and visit the new academy and go and revise your courses and so forth that you will find available to you there. And in the meantime, I wish you profitable trading, and I look forward to seeing you on our next webinar.